Today, we're diving into the latest developments surrounding the proposed crypto legislation in the U.S. Senate, specifically focusing on the draft bill from the Senate Banking Committee as of January 14, 2026. This draft aimed to provide clarity on market structure, SEC and CFTC jurisdiction, and important banking priorities, particularly concerning stablecoins and competition within the crypto space. However, just before a scheduled committee review and vote, significant pushback emerged, signaling a potentially rocky path ahead for this legislation. The most notable development came from Coinbase. On January 14th, Coinbase CEO Brian Armstrong publicly announced that the company could no longer support the bill in its current form. He explicitly stated that the draft is materially worse than the current status quo, a sentiment that carries considerable weight given Coinbase's influence in the industry. Armstrong outlined several key issues. First, he highlighted what he sees as a de facto ban on tokenized equities, which could severely limit promising areas of real-world asset tokenization. Second, he raised concerns about DeFi prohibitions that might enable broad government access to financial records, potentially eroding user privacy. A third point was the erosion of the CFTC's authority, subordinating it to the SEC, which he argued would hinder innovation. Finally, Armstrong pointed to amendments that would restrict or even eliminate rewards and yields on stablecoins. He believes this would unfairly favor traditional banks and reduce competition from crypto platforms. His strong stance is clear. Coinbase prefers no bill at all over a bad one, and they're committed to pushing for revisions. This move by Coinbase is seen as highly influential and could very well delay or even derail the planned markup session, with speculation that it might be postponed to address these significant concerns. Beyond Coinbase's direct opposition, other context around the draft includes further restrictions on passive yields for stablecoins. These rewards would only be allowed for active participation, like liquidity provision. This comes amidst ongoing worries from the banking industry about deposit flight to crypto platforms. There are also continuing debates over issues like self-custody, user privacy, risks related to illicit finance, and ethics provisions that limit officials' involvement in crypto. Some Senate Democrats have also been advocating for more review time, further contributing to potential delays. It's worth noting that related Senate efforts, such as drafts from the Agriculture Committee involving figures like Senator John Boozman, have also experienced postponements. Text releases and markups for those are now anticipated later in January 2026. The overarching goal remains bipartisan passage of comprehensive crypto legislation in 2026, potentially before the midterms. However, a long road lies ahead, involving reconciliation between committees, numerous amendments, and votes in both the full Senate and the House of Representatives. Industry sentiment toward the bill is currently mixed. Proponents view it as a crucial step to end the regulatory uncertainty caused by enforcement actions from the SEC and to boost U.S. innovation in the crypto space. Conversely, critics, particularly within the DeFi and exchange sectors, fear it might unduly favor traditional banks or lead to excessive regulation that stifles growth. While prediction markets like Polymarket have shown optimism for passage, recent events, especially Coinbase's withdrawal of support, could certainly shift that outlook. The situation remains fluid, with the Banking Committee markup standing as the immediate next milestone. We'll need to watch for any announcements regarding timing or revisions to the draft. If the bill evolves to address Brian Armstrong's points, support could potentially return. Otherwise, momentum may stall, pushing the industry toward further negotiation.